Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One of the other pairs that we were looking at back in November was the euro. And if you're trading, like I said, the U.S. dollar to the euro, you have to flip things around because your dollar is your base currency when you're looking at options. So your chart's going to look a little bit different because you've got it flipped over. And your symbol will be EUI when you're looking at the option for the euro. What you can see is that back in November, heading into November, the euro had basically done what we were kind of looking for on the dollar itself. It had already fallen sharply back into a strong zone of support. And so what I was looking for at that point was some sort of pattern at which it could correct off of this low and hold it forming into a longer correction at that time. Show you here how this is played out. Came into this support back here from 2006 and then bounced pretty strongly off of that low and is now, basically falling into a longer correction here. Now, when I'm looking at price patterns and time development, any type of thing that you're looking at and you think of a pattern, well, what you have to realize when you're looking at patterns in the market is that they're all made up with a number of components. A lot of people like to think of patterns in terms of, well, this is a bull flag or this is a head and shoulders or something like that. What they overlook a lot of times is that, okay, it might be a bull flag, but there's a lot of components that go into building the actual bull flag. And these components are going to tell you not only your probability of success on that flag itself, but also the most likely momentum movement coming out of the flag, whether it's higher chance of just triggering a setup and failing, or if it's actually going to be a base or correction that ends up being a reversal pattern and ends up, let's say it looks like a bull flag, but it ends up being a reversal pattern and actually turns into a short setup. The two main building blocks that we're going to look at today are going to be pace and momentum as well as support and resistance. Now, when I'm looking at trades, I have 5 major building blocks that I look at, and I've actually put together a course for this, which is located at www.swingtrader.net. I was basically doing a lot of one-on-one mentoring over the years, and just to help save time and stop repeating the same things over and over and over again and make it more widely accessible to everybody, I ended up creating a CD course which goes into detailing each of the 5 building blocks that I use. And like I said, this course can be located at swingtrader.net. It is not just a swing trading class. It basically applies to any time frame as well as any market. And that's the nice thing about the techniques that I use is that it really does transcend any time frame as well as any marketplace. So you can use it for trading options. You can use it for trading the ETFs, FX, futures, stocks. It really doesn't matter at all. When we're looking at Forex, a lot of times I don't rely as heavily upon things like volume as I do in the futures market and as well as in the stock market. But there are 2 main things that helped create the reason for those price patterns that we were looking at on the U.S. dollar index as well as the euro-dollar pair, and helping to determine where those would go. Since I don't have time to go into everything today, I'm just going to cover the 2 building blocks that made the most significant impact in that determination. If you'd like to kind of check out a little bit more, definitely go back and watch those archived webinars or go ahead and check out the course that I put together because you're going to learn a lot from those as well. Now, the two that we look at here are pace, momentum, and support and resistance. Now, let's look at these one at a time. Pace or momentum is just a really simple concept, but it's one that until I started teaching it about 6 years ago, most people had never even heard of it. And once you realize that this is something you need to look for, it just seems like, duh, why didn't I think about this before? And that's usually the reaction that I get from people when I'm working with them on this. And basically, it's just a measurement of the momentum of a trends move in a security. And it's compared not only to the average move, but also to the most recent move on any given time frame. There's a template that I like to use. I created it many years ago, and it's held up extremely well over the years. In fact, if you're looking at a number of specific charts, you will see price patterns develop exactly like you see on this chart itself, on this template itself. Basically, when you're looking at momentum, you're comparing a previous price move to a current one that's underway. And the core idea of this is really very simple. Basically, if you have a more gradual move as compared to an average move, particularly a substantially more gradual move or counter move, then your chances are higher that you will see a stronger break once that channel breaks. So if your channel is more of a sideways channel or a gradual pullback, such as marked here on A, then the chances are higher that when that channel breaks, the upper channel line from that breaks, you will see a very strong momentum move on the upside. Now, when that momentum begins to shift, which you see happen here at C, often the momentum on the breakouts from the channel will also start to shift. So you'll see slower upside breakouts. If it's the reverse, you'll see slower downside breakouts. When you find that you're seeing more of a V type of pattern, whether it's a V high or a V low, where prices fall very quickly into a low or very quickly off of a high, basically like we saw happen with the euro and the dollar recently, you're more likely to see a trading range develop. And so when you're looking at that type of a range, usually that previous high, the zone of the previous high, serves as a resistance level. We'll look at support and resistance here a little bit more detail in a minute. And when you're examining pace now, what you want to see is that within this trading range or this congestion itself, drop down to smaller time frames and look at the movements back and forth within a range. This will usually give you a heads up as to the directional break, what you will see in a particular security. In this particular case, we have the momentum slowing on the upside here with J, as compared to the previous downside move marked I. So that tells you that you're probably going to see a breakdown from that trading range. If instead we had seen a slower move off of the highs on I, it would have more likely led to a continuation move on the upside. So this is kind of one of those major tools, major things that I look at any congestion, whether it's a flag in which the congestion is somewhat tilted or slanted. For instance, you might have a trading channel that goes down like this. You're still going to look at the waves of buying and selling within that range. If it pulls up here, has a more gradual pullback than it did coming down into the lows of the range, well, the chances are higher that it's going to have that continuation for a bull flag. If the opposite happens, of course, let's say here's what looks like our bull flag, but it actually starts to slow, well, that flag is probably going to be a failure pattern where it can more likely break through that lower trend channel and end up being the beginning of a larger reversal pattern. Usually this particular one actually will build on itself and pick up momentum on the downside. Ram asked, C is the potential for a breakout, right? B has a strong move, C has a gradual pullback, so expecting D to be a breakout. That would be exactly correct.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.